Hello students, welcome to the class of Financial Markets and Institutions. Today's topic is the instruments of capital market. What are the instruments used in capital market? We already know that capital market is a market where long-term funds are lent and borrowed, or where dealing or trading is done in long-term funds. So it refers that all the facilities and financial institutional arrangements which help for borrowing and lending term funds, that is medium and long term funds. Capital market instruments are divided into two categories, that is equity shares and debt securities. Equity securities are further divided into two categories. They are equity shares and preference shares. And debt securities are further divided into two categories. They are debentures and bonds. So, what do you mean by equity share? Equity share, according to the Companies Act 1956, equity shares are that part of the share capital of the company which are not preference shares. So, equity shares are called as ordinary shares or common stock or voting shares. So, equity shares are long term financing sources for any company. So, a company raises its capital with the help of equity shares. These shares are issued to general public and are non redeemable in nature, which means investors in equity shares hold the right to vote, share profits, and they also claim assets of the company. So, the holders of equity shares can be called as the owners of a particular company. So, if Mr. A holds some shares in a company, like some equity shares in a company, then that person can be said as the owner of that company. So, when you invest in equity shares, you become a fractional owner of that company. As an owner of equity share, you have the right to vote in annual general meetings of that company and have a word in working of the company. You can also take part in decision making of that company. Clear? In simple, equity shares can also are used by the companies to raise capital. Okay, so the person who buys those equity shares can be said as the owner of that company, not the major owner but fractional. The owners can be divided into many people, because any person who buys those equity shares can be said as the owner of that company, and he has the right to vote and also take part in decision making of that particular company. Holder receives dividends from the company as return. So the profit earned by the equity shareholder is known as dividend. They receive their return as dividend. However, it is important that the rate of dividend is not fixed. Okay, so the features of equity shares are permanent in nature, which means these shares are the permanent assets of the company and are returned only when it winds up the company. So if a person buys equity shares, they can not be redeemable. They can be returned or redeemed only when the company closes or the business closes. Clear? So therefore equity shares are permanent in nature. Equity shares are transferable and dividend payout. So, equity shares can be transferred, which means the ownership of equity shares can be transferred from one person to another. And also, the dividend payout depends on availability of surplus of funds. So, paying dividend depends on the profit making of the company. So if the company make profits, then it can divide it can distribute dividend to its equity shareholders. But if the company does not make any profits, then they can postpone the payment of dividend, or they can stop paying dividend until they make profits, because as the holders of equity shares are the owners of the company, the profit or payment of dividend can be postponed. Next, equity shares have higher returns on investments. If you have high risk, then you can opt for these shares to earn greater returns. So, equity shares earn higher returns than other shares. Yeah. So equity shares are permanent source of finance to the company, and there is no fixed rate of dividend. So 1 year the company may pay higher returns, 1 year the company may pay lower dividends, lower rate of dividends. So the payment of dividend completely depends on the rate of profits the company earns, and easy liquidity and marketability, which means it can easily be converted into cash, and equity shares are easily marketable without any problems or without following any lengthy procedures. And there is no fixed rate of dividend for equity shares. So as the company earns profit, the profits are divided as dividend among the shareholders. But if the company does not make any profit, then they do not pay dividends for that particular period. ಸಂಸ್ಥೆಗಳು ಇಕ್ವಿಟಿ ಶೇರ್ಸ್ ಅನ್ನು ಖರೀದಿಸಿದಾಗ ಷೇರುದಾರರು ಮತದಾರನ ಹಕ್ಕನ್ನು ಹೊಂದುತ್ತಾರೆ, ಮತ್ತು ಅಂತಹ ಸಂಸ್ಥೆ ಲಾಭ ಗಳಿಸಿದಾಗ ಲಾಭಾಂಶದಿಂದ ಲಾಭ ಪಡೆಯುತ್ತಾರೆ ಅಥವಾ ಲಾಭವನ್ನು ವಿತರಿಸಲಾಗುತ್ತದೆ. ಷೇರುದಾರರು ಅಂತಹ ಸಂದರ್ಭಗಳಲ್ಲಿ ಕಂಪನಿಯ ಷೇರುಗಳನ್ನು ಹೊಂದಿರುವ ಕಾರಣ ಅವರನ್ನು ಮಾಲೀಕರು ಎಂದು ಪರಿಗಣಿಸಲಾಗುವುದು. ಸೊ ಇಕ್ವಿಟಿ ಶೇರ್ಸ್ ಹೊಂದಿದವರನ್ನು ನಾವು ಕಂಪನಿಯ ಮಾಲೀಕರೆಂದು ಕರೆಯಬಹುದು. Equity shares can be said as there is no guarantee on returns to the shareholders. So sometimes the equity shareholders may get returns, but sometimes they do not get any returns. But they are always the owners of the company. They always hold the ownership. The other drawback may be loss of managerial control, which means you may lose the control of your company. You may not have the opportunity to completely control that particular company where you hold your equity shares. Next is preference shares. Preference shares are known as preferred stock. Preference shares, also commonly known as preferred stock, is a special type of share where dividends are paid to shareholders before to the issuance of common stock dividends. Before issuing any dividends to other stock, preference shareholders get dividend, or they receive dividend. Preference shareholders hold preferential rights over common shareholders when it comes to sharing profits. So whenever it comes to share profits, preferential shareholders first receive the dividends. They are the first one to receive dividend. Therefore, the name itself suggests that preference. So more preference is given to preference shareholders whenever profits are distributed. If a company goes bankrupt, preference shareholders are issued dividends first, or have the first right to the company's assets before equity shareholders or common stock investors. Shares are the secondary source of finance for a public limited company. The holders of such preference shares enjoy exclusive rights or preference by the treatment that company in specific aspects. So preferential shareholders enjoy exclusive rights more rights or more, they get more preference. They are likely to receive their dividend before equity shareholders. However, they do not have any voting rights. So preference shareholders do not have any voting rights and they are not regarded as owners of the company. Only equity shareholders can be regarded as owners of the company, but they may, or they sometimes may get dividends, sometimes they do not get dividends, but preference shareholders always have preferential rights over dividends. Clear? ಮೀನ್ಸ್ ಆದ್ಯತೆಯ ಷೇರುಗಳು ಸಾರ್ವಜನಿಕ ಸೀಮಿತ ಕಂಪನಿಯ ಹಣಕಾಸಿನ ದ್ವಿತೀಯ ಮೂಲ. ಹೆಸರೇ ಸೂಚಿಸುವಂತೆ ಅಂತಹ ಷೇರುಗಳನ್ನು ಹೊಂದಿರುವವರು ನಿರ್ದಿಷ್ಟ ಅಂಶಗಳಲ್ಲಿ ಆ ಕಂಪನಿಯ ವಿಶೇಷ ಹಕ್ಕುಗಳನ್ನು ಅಥವಾ ಆದ್ಯತೆಯನ್ನು ಹೊಂದುತ್ತಾರೆ ಅಥವಾ ಆದ್ಯತೆಗೆ ಹಕ್ಕುದಾರರು. ಕ್ಯಾಪಿಟಲ್ ಇನ್ಸ್ಟ್ರೂಮೆಂಟ್ ಆರ್ ಡಿಬೆಂಚರ್ಸ್. ಸೊ ವೆನ್ ಅ corporation is in need of funds in addition to share capital, it borrows money by issuing debentures. Debentures are a debt instrument used by different companies and the government to issue loan. So loan is issued to corporates based on their reputation at a fixed rate of interest. So for the debentures issued, rate of interest are fixed. Debentures are also known as bond, which serves as an IOU between issuers and purchaser. So debenture may be a written document which serves as a proof between the issuers and purchasers, where it states the terms and conditions of the debt and period of the debt. So companies use debentures when they need to borrow money at a fixed rate of interest for their expansion. Whenever a company wants to expand itself or to start a new business or to raise funds, debentures may be issued. So debenture holders get interest which is fixed at the time of issue. So at the time of issuing debentures, the rate of interest are fixed. Debentures are completely issued on the basis of mutual trust and there is no collateral required to issue debentures. So to issue debentures, no security can be required. So a person who takes debentures or a person who receives debentures does not need to provide any collateral or a security. ಸೊ ಡಿಬೆಂಚರ್ಸ್ ಅಂದರೆ ಸಾಲ ಪತ್ರ ಅಥವಾ ಸಾಲ ಭದ್ರತೆ. ಇಲ್ಲಿ ಸಾಲವು ಸಂಪೂರ್ಣವಾಗಿ ಪರಸ್ಪರ ನಂಬಿಕೆಯನ್ನು ಆಧರಿಸಿದೆ. ದ ನೆಕ್ಸ್ಟ್ ಕ್ಯಾಪಿಟಲ್ ಮಾರ್ಕೆಟ್ ಇನ್ಸ್ಟ್ರೂಮೆಂಟ್ಸ್ ಆರ್ ಬಾಂಡ್ಸ್. Bonds can be said as a loaning instrument where a bond's issuer is the borrower, which means that the person who issues bond is a borrower or a debtor, and whereas the person who receives those bond can be said as creditor. So bondholders are considered as creditors concerning such an entity and are entitled to periodic interest payment. So bonds can be said as a document or a certificate which states about the loan received by the borrower and the rate of interest at which the rate of interest for that particular principal amount. So the issuer or the borrower states or issues a bond stating that he has received so and so amount of money as loan and he will be paying some kind of interest rate for that particular amount received as loan and for the period of time, and the time period is also mentioned in that particular bond, or maturity date is also mentioned in the bond. So the bondholder receives or the creditor receives those bonds as a proof that he has given some kind of loan to the borrower. So bonds are commonly issued by public authorities, credit institutions, companies, and supranational institutions in primary market as well as secondary market. And bond is a negotiable certificate which states the terms and conditions of repayment of the principal sum plus interest rate. And the most common process of issuing bonds is through underwriting. So bonds are issued through underwriting. ಸೊ ಬಾಂಡ್ಗಳನ್ನು ಸಾಲ ನೀಡುವ ಸಾಧನ ಎಂದು ಕರೆಯಬಹುದು ಅಥವಾ ಸಾಲ ಪಡೆದುಕೊಳ್ಳಲು ಉಪಯೋಗಿಸುವಂಥ ಒಂದು ಸಾಧನ. ಬಾಂಡ್ ನೀಡುವವರು ಸಾಲಗಾರರು ಮತ್ತು ಬಾಂಡ್ ಪಡೆಯುವವರು ಅಥವಾ ಹೊಂದಿಕೊಳ್ಳುವವರು ಸಾಲ ನೀಡುವವರು. ಬಾಂಡ್ಗಳಿಗೆ ಸೀಮಿತ ಅವಧಿ ನಿಗದಿಸಲಾಗುತ್ತದೆ. ಓಕೆ, ಸೊ ದೀಸ್ ಆರ್ ಫ್ಯೂ ಕೈಂಡ್ಸ್ ಆಫ್ capital market instruments. There are few more capital market instruments, but equity shares or ordinary shares, preference shares, debentures and bonds are most commonly used capital market instruments. So some of the capital market instruments are non-voting equity shares, where the equity shareholders do not get any voting rights. Next, cumulative convertible preference shares. So preference shares can be converted into equity shares or debentures. Next is company fixed deposits, warrants, secured premium notes, euro convertible bonds or global depository receipts, government securities or gilt-edged securities, stock certificates, promissory notes, bearer bonds, etc. So these are few kinds of capital market instruments. Capital market plays an important role in ensuring the emergence of efficient economy or developed economy. It helps in internationalization of an economy by linking it with the rest of the world. So capital market is very important in developing an economy or developing a country's economy. So here ends your second chapter, that is financial markets. Thank you.